let's shift to collateral for a moment. And I think the SBA rule is real simple here. And Eric, can you join in and on the collateral side of things at U.S. Bank and within the SBA business? What's your view of collateral?
Yeah, we follow SBA guidance in terms of if collateral is available, we'll need to see that injected or pledged to the transaction. So we've again are fairly consistent with SBA. I want to just take a second with regards to injection to share a little bit what we do. We're at around the 25% on the startup, and we go down to 15. We do like seller carryback. I think I'm not certain. I'd be curious to hear from the crowd in terms of their philosophy on that. For us, having that into the deal is very helpful in terms of transition. The other piece that we see on occasion are partner buyouts, and on those, depending on what the business, we can require up to no injection on that transaction.
Good. One of the things that I appreciate that, Eric. One of the things that we've chatted about earlier is even within the SBA rules, the SBA is clear if collateral is available, it needs to be pledged. Kevin, Atlantic Coast Bank, when you think about collateral that's out there, and tell us what you're seeing on the personal financial statement and the level of detail that you guys are going to make sure you're being compliant there.
Yeah, we're definitely seeing heavy scrutiny on the PFS in regards to liquidity, in regards to disclosure of other assets. In fact, I'm seeing a much higher level of, us, having to take, if there's excess cash, for example, that could be pledged. Marketable securities, even down to small balance. So there's definitely more heavy scrutiny, on the PFS.
Okay, great. I appreciate that. And so one of the questions is, let's understand, what's being done in SBA, what's being done outside of SBA. Doug, as a non-SBA lender, as a conventional lender, tell us your view of how you're viewing collateral today.
Sure. We are a conventional cash flow-based lender, and the first thing I want to clarify is when I was talking about 100% financing for new builds, that would be 100% financing of leaseholds and equipment. Typically, our borrowers would handle the working capital as well as franchise fees. So in the end, it really comes out to about 80% of total project costs and 100% of leaseholds and equipment. So I just wanted to clarify that. In regards to collateral, the way we look at collateral is we're as a conventional lender, we're not bound to take equity in residences or commercial real estate just because it's there. So we actually never look at real estate as collateral across the board. We are strictly a non-real estate lender, and the way we'll look at it is we look at the cash flow of the operating units that we're going to have UCC1s against, and then we use a multiplier to determine an enterprise value, and the multiplier can vary. It's typically a multiplier of EBITDA. Sometimes it's a percentage of revenue or a multiplier of revenue. Whatever that enterprise value is that we're going to have for the stores that we're going to have UCC1s against, we look to be at about an 80% loan to enterprise value. So typically if there's, say, a 5-store operator out there and 4 of the stores came on board in the last year or so, in all likelihood, getting to that 80% loan to enterprise value would require some injection on the borrower's side. In a scenario where there's a lot of cash flow from units that have been operating for a while, in all likelihood, we'll be able to get up to that 100% finance.
Okay, I appreciate that. And one of the questions that we're receiving, Doug, is, and I think people understand where SBA pricing is from a rate perspective. That's obviously well understood in the market. On the product you're talking about, Jen, can you give us a sense of where pricing is from a rate and structure standpoint?
Sure. First and foremost is we're talking about fixed rates for the life of the loan, not variable rates. And the rate range, you're probably looking anywhere from as low as 7 on refinances, 7 to 7.5 on refinances, and as high as 8 to 8.5 on new builds. And a lot of that depends on our comfort level with both the borrower, and the franchise concept.
Yep. And so let's shift. Let's stay on the discussion of collateral. I'd like to bring Rob into this. Rob, you're a leaseor. Talk to us about how you view collateral and the role it has and the levels of collateral that you're looking for in both hard and soft costs.
Well, we primarily finance equipment acquisitions. We also do merchant cash advance and working capital. But on the as far as equipment goes, we look to finance any type POS system up to doing a full re-image. But we look about 30% soft cost, 70% hard is our mix.